Hello everyone. Welcome back to this week's Market Outlook. Where are the markets headed this week? Let's jump right in. This week's theme is, the fate of the AI bubble is 1929 about to repeat? This prediction is based on statistical analysis using the past 200 weeks of data on exchange rates, interest rates, and 17 other financial markets. But first, let's review last week's predictions. Last week, a UDJPY, 10-year JGB yield, the Nikkei average, and the Dow Jones Industrial Average all reached their predicted convergence points. Congratulations to those who booked profits. Now, let's look at this week's convergence point, essentially, our target levels. USD JPY is 152 yen and 90 sen. Euro JPY is 175 yen and 26 sen. AUD JPY is 99 yen and 43 sen. The Nikkei 225 is 48,315 yen. The Dow Jones is $46,297. 10-year JGB yield is 1.74%. Gold is $3,951. We expect the markets to gravitate toward these levels. Last week's market summary. Last week, risk-off sentiment accelerated following a decline in U.S. equities. Capital flowed into safe haven assets, U.S. Treasury prices rose, and yields fell. Then came the U.S. employment report released at the end of the week. The unemployment rate worsened by 0.1%, and August's non-farm payrolls were revised downward once again. These figures clearly indicate a steady deterioration in the U.S. labor market, reigniting expectations of a December rate cut. Why are stocks rising? The equity market is rebounding on hopes for lower rates. But this is where we need to be careful. We must not forget that it is the sluggishness in the equity market that is causing yields to fall, not the other way around. Some investors expect lower yields, higher stock prices. But this is a classic mistake caused by confusing correlation with causation, something frequently observed in financial markets. Moreover, this fallacy tends to become especially widespread during bubble markets. Echoes of history, parallels with 1929. Looking at today's market environment from both fundamental and technical perspectives, the similarities to the period just before the 1929 stock market crash are striking. Interest rates, equity trends, labor conditions, investor sentiment. Whichever angle you examine, it is undeniably that the market is filled with warning signs. Extreme caution is required from here. This week's Outlook: FX and equities. In terms of interest rates, US and European yields are declining, while Japan's yields are rising. If this trend continues, USD JPY is expected to drift toward a weaker dollar and stronger yen. As for the equity market, AI-related stocks are likely to remain the main driver. However, the foundation for this rally rests on only one expectation. Lower rates will fuel more AI investment. This is an extremely fragile justification. And it is no exaggeration to say that the risk of an AI bubble collapse is rising by the day. Please note these forecasts are based on a statistical convergence model. We cannot take responsibility for any investment outcomes based on this analysis. That's all for this week's Market Outlook. We will continue to bring you data-driven forecasts. I look forward to seeing you again next time. Thank you for watching.